The oil market's mystery, a looming glut or a mirage. The International Energy Agency IEA has issued a bold prediction, but a crucial detail is missing. The IEA's latest report predicts a massive oil glut, with a surplus of 2.35 million barrels per day in 2025 and a staggering 4 million barrels per day in 2026. This forecast, released on October 16th, has sent shockwaves through the market. But a critical question remains. Where are the oil barrels to support this claim? The IEA's dilemma. In a surprising twist, the IEA's own data reveals a significant gap. The agency is unable to account for 1.47 million barrels per day of oil in its global balances for August, a figure that represents 1.4% of annual demand. This unaccounted for oil is a mystery, and its absence could dramatically alter the market's trajectory. But here's where it gets controversial. The IEA's bearish outlook clashes with OPEC's forecasts, which predict a much tighter market. OPEC expects global oil supply to closely match demand through 2026, a stark contrast to the IEA's prediction. This disagreement between two major energy authorities has traders and investors scratching their heads. The missing barrels. The IEA's August report highlights a blind spot in the global oil market. The 1.47 million barrels per day figure is a massive discrepancy, and it could mean the difference between a significant oversupply and a more balanced market. If the missing barrels are found, the oversupply could shrink to a mere 500,000 barrels per day, a much more manageable figure. But if they remain unaccounted for, the glut could grow to 3.5 million barrels per day, a scenario that would undoubtedly impact crude prices. The IEA's calculations are based on a complex web of data, including official government statistics and figures from private companies and analysts. However, the sheer size of the global oil market means that holes in the data are not uncommon, especially with delays in reporting and the absence of some datasets. Disappearing act. The IEA attributes the August discrepancy to potential delays in data reporting and the lack of information from non-OECD countries. But there's more to the story. The global oil market has been grappling with two significant factors: the trade of heavily sanctioned oil and China's massive stockpiling. Sanctioned oil. The volume of seaborne crude oil has reached unprecedented levels, with analytics firm Kepler reporting 1.25 billion barrels last week, excluding the pandemic era. This buildup is largely attributed to oil from Russia, Iran, and Venezuela, which is transported on shadow fleet tankers to evade sanctions. The lack of transparency in these shipments could be a significant contributor to the IEA's missing barrels. China's oil hoard. Global oil inventories have surged, with the IEA reporting a 225 million barrel increase between January and August, the highest in 4 years. China, the world's largest oil importer, is believed to be a major player in this buildup. However, Beijing's secrecy regarding its oil storage capacity and inventory changes adds to the mystery. The IEA's estimate of a 110 million barrel increase in Chinese crude stocks between April and August 2025 may only scratch the surface. The geopolitical fog. As the world's geopolitical landscape shifts, the task of accurately tracking the global oil market becomes increasingly challenging. Sanctions, trade secrets, and government opacity are all factors that contribute to the IEA's missing barrels mystery. As the agency continues to refine its data, the market awaits clarity on the true state of the oil glut. What's your take on this oil market enigma? Do you think the missing barrels will be found, or is the IEA's prediction overstated? Share your thoughts in the comments below, and let's explore the complexities of this global energy puzzle.